Hedging is a risk management strategy used by investors and businesses to offset or mitigate the potential losses from adverse price movements in an asset or a liability. The primary goal of hedging is to protect against downside risk while still allowing for potential gains. It involves taking an offsetting position in a related instrument or asset class to reduce the impact of adverse price movements. The first step in hedging is identifying the specific risks that need to be managed. These risks can arise from various sources such as changes in commodity prices, interest rates, foreign exchange rates, stock prices, or even weather conditions. Once the risks are identified, the next step is to select an appropriate hedge instrument. This could be a financial derivative such as options, futures, forwards, or swaps, or it could involve taking a position in a correlated asset that moves inversely to the risk being hedged. Let's delve into the types of hedging. These are agreements to buy or sell an asset at a specified price on a future date. Forward contracts are used to hedge against price movements in commodities, currencies, and other assets. Similar to forward contracts but traded on organized exchanges, futures contracts are standardized and highly liquid. They are often used by investors to hedge against price fluctuations in financial instruments and commodities. Options give the holder the right but not the obligation to buy or sell an asset at a predetermined price within a specified period. They are commonly used for hedging against price movements in stocks, currencies, and interest rates. Swaps involve the exchange of cash flows or liabilities between two parties based on predetermined terms. They are used to hedge against interest rate risk, currency risk, and other financial risks. This involves offsetting risks by taking positions in assets or liabilities that naturally move in the opposite direction. For example, a company that earns revenue in foreign currencies may naturally hedge its currency risk by holding assets denominated in those currencies. Once the hedge instrument is selected, the hedging strategy is implemented by taking an offsetting position to the risk being hedged. This position is typically adjusted over time to maintain the desired level of protection. Hedging strategies require ongoing monitoring to ensure that they continue to effectively mitigate risks. Adjustments may be necessary as market conditions change or as the underlying risk profile of the portfolio evolves. While hedging can reduce the impact of downside risk, it also comes with costs such as transaction fees, margin requirements, and the potential for foregone gains if the hedged asset performs well. Therefore, investors must weigh the benefits of hedging against the associated costs and trade-offs.